I think it's pretty easy. This market could rally to 56, 5,700, and that would actually provide you a pretty decent exit point to reduce equity. Now, let me be clear. I said reduce equity, not sell everything in the markets. There's some stuff in the market that is getting ridiculously cheap.
Welcome to Thoughtful Money. I'm Thoughtful Money founder and your host, Adam Taggart, welcoming you back here at the end of another week. And what a week. I am joined as usual by my good friend, portfolio manager, the liberated Lance Roberts. Lance, how you doing?
Feeling liberated. It's awesome. I don't know what that means, actually.
Well, of course, that was a reference, folks, to Liberation Day. That was President Trump's announcement of what was billed as reciprocal tariffs. Really, how it manifested was actually quite different than many people expected. Certainly different than what Wall Street expected. We had a bloodbath in the markets yesterday, looking like it's going to be surpassed today. Lance and I were recording this on Friday morning. Lance, when I just peeked, the S&P was down something like 4.5 or something like that. A lot of deep red on the screen. So, Lance, I guess the question everybody has for you is what's going on? Is this the big one, or will this too pass?
Well, this too shall pass, obviously. You know, there's a difference between a event-driven correction, which is what this is, right? We have an event that's driving a correction versus an economic recession or a financial crisis, those type of things. We don't have a financial crisis going on, but what we do have is this whole event driven around tariffs. And again, we can get into kind of the details, you know, today of all these tariffs, but they were worse than expected. They were not really tied to any type of reciprocal tariff. It was poorly done and poorly executed, and now it's left the markets in a real state of kind of unknown address. And now China, as opposed to what was expected, again, everything is working against expectations. Expectations were that tariffs were going to be somewhere between 10 and 20%, not 34%, like on China as an example. They also didn't expect that China would retaliate and come back with a 34%, reciprocal tariff, and which is what we put on them, as well as an export ban on certain materials. Now, you know, we can talk about the details of that. This is China negotiating, putting themselves in a position to negotiate, but this is all far beyond what the market was set up for, and so the markets are responding accordingly because, again, this is all going to have major impacts to earnings revisions over the next 12 to 18 months.
All right, so we'll go through the technicals. I think the big question that everybody has on their minds, which obviously, Lance, you can't answer, but you can speculate, which is, when's this going to end?
Right.
But a couple of things. One, folks, so at this point, at least as of recording, the S&P is now down about 15% from its high earlier this year, its all-time high. NASDAQ's down 20%, so NASDAQ's officially in correction now. The 10-year is under 4%. All right, Lance, well, look, I guess before we pull up the TA there, you and I did a real-time event yesterday. You're not thrilled, I think, about sort of the logic behind these. Why don't you explain, if you can, just real quickly, why you think the calculus that was used, the calculations that were used for the tariffs that we put on these countries was flawed? Why we shouldn't be using a trade deficit as a proxy for reciprocal tariffs?
Well, the trade deficit doesn't have anything to do with tariffs. One of the things that Trump administration is taking some slings and arrows for is that we tariff the island of McDonald, which the only people that live there are penguins. So what tariff did penguins put on us? And look, it's, that's an outsized example, right? But it's the point that somebody didn't do their job when they went to Trump and said, hey, here's our tariff. You want to do tariffs? Here's our plan to do it. We're going to do this. Somebody should have picked up on the fact that the outlet of McDonald doesn't have any people on it to tariff, right? So we just imposed a 10% tariff on an island that can't pay it, right? So it's just ridiculous. So, but tariffs are a tax or a VAT, a value-added tax, put on a specific good or service that's imported or exported from a country. So, for instance, if we talked about Japan. Japan has a 700% tariff on U.S. rice because they want to protect their rice farmers in Japan. Look, Japanese rice is far better than American rice any day of the week, but this is Japan's point. So if you wanted to do a reciprocal tariff, what it should have been was a 700% tariff on Japanese rice coming into the U.S. Or if we tariff butter or dairy products or anything like that. This should have been an item. You should have taken each country that you wanted to tariff, item by item, look at what's actually being tariffed, and then apply a reciprocal tariff. That's what Wall Street was expecting. The trade deficit doesn't have anything to do with tariffs. That's just the difference between what we import to a country and what we export from them. And there's some countries that we should run a trade deficit with. They're simply that they don't really manufacture anything that's, we don't manufacture things that they particularly need. These are in poorer countries in particular.
Right. Or they're just smaller countries.
Yeah, these are smaller countries. So they don't import a lot of things from us, but we export a lot of maybe raw materials or base products from them, et cetera. So there's this deficit on trade. That's not a tariff. That's just a differential between the imports and exports from those countries. But when this plan, whether it was Howard Lutnick or whoever that put this ultimately together, said, oh, here's the magic formula for this, they just used the trade deficit and they cut the deficit by half and said, oh, that's the tariff. But that was a very flawed approach to this. And this is why the market's reacting so negatively, because these tariffs are much more onerous than what they should have been. And more importantly, they're much more onerous on smaller countries, poorer countries, than they need to be. And so this is why the market's really having a lot of difficulty with this. This is obviously going to increase the risk of recession, although we don't have any economic data. Today's report on our website and on our Substack channel this morning is talking about the S&P as a leading indicator for recessions. The economic data is not recessionary. We just saw the employment report out this morning. Doesn't mean it won't become recessionary in the months ahead, but right now the important thing is this is an event-driven, a very specific event, these tariffs, that's driving the sell-off. And the problem with extrapolating this event into a bigger cycle is that tomorrow, I'm not saying this is going to happen at all, but literally tomorrow could come out, Trump could come out tomorrow morning and say, hey, I had a great phone call with President Xi. We decided to take tariffs off both countries. We're gonna go back to status quo for now, right? Or some negotiation. This market's going to be up 5% in a day on that news. So that's the risk here with this type of sell-off, is that it's very subject to a change in the news flow versus this being a more fundamentally driven sell-off in the markets, if that makes sense.
No, it makes total sense. I was going to deliver sort of a similar warning here, which is that, unlike an event, and I'll use a sad one, but like 9/11, right? The plane's not going to ever not fly back out of the building, right? It's an event that can't be reversed, where this could be reversible, right? And actually, I believe that is the plan, right? Classic Trump, pull out a really big stick and then start offering carrots and hope everybody takes your carrots instead of you having to use the stick, right?
Right.
So, we talked a little bit about yesterday. People were saying, hey, should I short this market? You warned about the danger of using leverage ETFs. But if you're going to take a short position here, you just got to be aware that, to your point, this thing could change on a dime and you could see the market up a tremendous amount in a very short period of time, making shorts very dangerous, right? All right,
Yeah.
because you mentioned it as an event, let me ask you this. So, it's not necessarily a fatal, thing. It's not something that we may not be able to get out of for a long time, say like we fall into a real deep economic slowdown. And I know you're concerned the economy is slowing, but because this is an event, so I'm seeing a lot of chatter on X right now, Twitter, people saying like, "Wow, it's not that bad. It's not like the great financial crisis or anything like that," and it's not yet, at least. But my question is when you have an event like this that does catch everybody by surprise, right? You get a lot of overextended players that didn't have this on their bingo card, who maybe were positioned in a way where this could be fatal, right? And so my question to you is what's the risk right now, do you think, of some hedge funds, private equity players, maybe some private lenders, maybe starting to blow up here because they were exposed to this type of risk and didn't realize it?
There's certainly a risk of that. Probably as we're speaking, I think it's at, hold on a second, let me just double check my calendar. I think it's 10:30 Central Time this morning. Jerome Powell's going to be speaking. So he's making a speech. And I'm sure he's been getting some phone calls from his member banks, JP Morgan and Bank of America, et cetera, talking about what's going on here, because obviously there's risk to the banks. In particular, JP Morgan's down like 7% today with kind of on this news of tariffs, because again, what we're seeing is that bond yields are dropping sharply. Like you said, we're under a 4 handle now on bonds. And, I'm sure that Paul Tudor Jones wishes he owned some bonds now, along with Stanley Druckenmiller, as I was writing at the end of last year. But that spread differential is increasing. Now, we've talked about this before, as kind of the big key indicator to watch is credit spreads. And I'll share kind of an update. I just updated this morning for you. So this is where you need to be very careful, though, when reading some of the media stuff, right? So if you're a frequenter to Zero Hedge or some of these more kind of bearish leaning outlets, what they'll only show you is this little end piece over here. So like, here's credit spreads since 2025. Credit spreads are blowing out. Yes, they're up, but you have to put these in perspective. And that's why I'm showing you a long-term chart of this. Yes, they're ticking up, but they're not at levels that are normally consistent with a real economic or financial crisis at this point. Doesn't mean they won't get there, but it certainly suggests that there's a rising level of risk, which is why this is starting to impact the banks. But we want to keep a close watch on this for sure. But again, the credit spreads are saying there's certainly some risk here, but they're not at levels that suggest that there's a bigger economic or financial systemic event on the horizon. Again, at this moment, at least, this is an event-driven issue with the markets. The problem is that if there's not a resolution, this could become an economic or credit-related event down the road, and that's what markets are trying to price in that uncertainty of. But again, I just want you to be really careful here of extrapolating this event-driven issue right now versus a more systemic issue. This isn't like the subprime crisis in 2008. This could be resolved tomorrow just by the stroke of a pen, literally. And that's something we can talk about as well, as about the validity of these executive orders when it comes to tariffs. But this could be resolved tomorrow with the stroke of a pen.
Okay. Yep. A couple of things. So yes, we're not in the danger zone yet on that chart, but it is notable. It does look like we have bottomed and reversed. Trend is reversed after a couple of years. Credit spreads, as we've been looking at for a long time, have been looking like a dead corpse. I think even last week I made the joke about we're seeing a leg starting to twitch. It's not like he's getting up and dancing yet, but now it looks like maybe a couple limbs are moving at this point in time, right? So we'll obviously watch this closely. Yeah. And that this could become sort of a self-fulfilling prophecy is what you're saying, right? If these tariffs don't get removed, if better trade deals don't get negotiated from here, you're pretty confident that will then push the economy into recession.
Yeah, and that's just a function of the potential impact kind of, just in the overall market itself, because again, these tariffs are a real thing, right? And again, when you're imposing a tax, somebody's got to pay that tax, and that's certainly going to reflect into earnings. And earnings estimates are getting revised down rather sharply. So, again, you can't discount this at all, but you just want to be careful of extrapolating a one-time event relative to a much more macro environment. And again, we could get there. Hopefully some saner heads will, intervene at this point. And this is kind of and actually there was a lawsuit filed today. And this is going to be really interesting. This is a challenge being filed, and I apologize, I don't have the name of the group just off the top of my head that actually filed this challenge, but you could probably look it up for me. But they filed a challenge based on the validity of these executive orders on tariffs, because tariffs are a tax which are part of the congressional oversight. So Congress controls, the House of Representatives controls the purse. So they control, again, this is why if you want to pass tax cuts, you got to pass a bill through the House. Well, kind of the same thing goes with tariffs. You're enacting a tax. So in theory, Trump may have usurped his constitutional authority by using an executive order to do these tariffs without pushing them through Congress. So one thing that could happen here in theory, and again, this is all theory, I don't have any idea, I'm not a constitutional scholar, is that if this challenge is successful, it could cause a repeal of these tariffs, and then he's going to have to run it through Congress to try to get these tariffs put into place, which would probably be a much more realistic view of tariffs on countries if it was able to pass. Again, the majorities are pretty slim at this point. But if he's able to get something passed, it'd probably be a much more realistic tariff on other countries versus what this kind of trade deficit method is. So again, there's some that my point is there's a lot of things that can happen over the next few days, if not the next months. Now, I want to talk about China just real fast too. One thing of note on all these tariffs is, like, for instance, Trump's tariffs on China don't start till April the 9th. China's response is, we're going to put tariffs on you on April the 10th. So if I'm China, that's actually the right response, because if I'm President Xi, I don't want to come to the negotiating table and say, oh, Trump, you put tariffs on me, we need to work something out. We can't take the tariffs. That's not the way you negotiate. You don't negotiate from a position of weakness. So I think President Xi responded correctly today. He announced reciprocal tariffs that are just as absurd as the ones we put on China, and gave it till April the 10th. So now this gives Trump and President Xi time to get on the phone and say, okay, you're being ridiculous and I'm being ridiculous. Let's do something realistic between the two of us and come to a better agreement. So he can negotiate from a position of strength at this point. So and so don't be surprised that in the next few days over the weekend that we get some type of news that will lead this market to have a little bit of a reflexive rally. Having said that, I would sell on the rally, and I will be selling on the rally. So when we get this rally, I will be reducing equity risk on this rally. I think there's a realistic possibility this market could rally. I think it's pretty easy this market could rally to 56, 5,700. And that would actually provide you a pretty decent exit point to reduce equity. Now, let me be clear. I said reduce equity, not sell everything in the markets. There's some stuff in the market that is getting ridiculously cheap. NVIDIA, Google, Amazon. Some of these stocks are getting so beaten up here. There's going to be some really good entry points to have that exposure in your portfolio if you don't own it already. I'm not saying go crazy and just buy, that's the only thing you have in your portfolio. But some of these Mag 7 stocks are getting really, really beaten up. And when you look at earnings growth for 2025 and then 2026, they are the only companies really generating any earnings growth whatsoever. So, kind of looking forward down the road, once we get past this, you're probably going to want to own those companies. But, I think you're going to have a better entry point over the course of the next, month or two to start maybe picking up some of those assets at better levels. So definitely look to use this rally to reduce some equity risk. When we get this rally, I will likely expect to see bond yields reverse a bit. Bond yields have been doing great here lately. And again, I kind of, I wrote that article about Paul Tudor Jones last year. It's like, Paul Tudor Jones, I won't own bonds. And we wrote exactly why you should own them is because in an economic environment that is slowing down like the one we're in, yields are going to fall, which is exactly what's happening, but they're overbought now. So when we get this rally in stocks, expect to see money come out of that safety trade, go into the stock trade for that rally. So look to take some profits in bonds, move that into equities, on, kind of at some point in the future. So sell some bonds, hold that cash on this rally, sell some equities, and then we're going to go through another down leg as people kind of work through this process. And at some point, you want to add those equities, and yields will kind of rise up, and you'll be able to buy bonds cheaper, rebalance your portfolio a bit. So this rally that we should get in the next few days, next couple of weeks, whenever it occurs, you want to try to navigate that fairly carefully.
Okay, and folks, if you want to keep tabs on when Lance's firm is making all those changes, just keep watching this program every week, or if you're really into it, watch Lance's program every morning.
Yeah, or subscribe to our Substack, because when we post trades, they're going to be up there too. So, right.
All right. Okay. So I want to. There's sort of a big discussion I want to have on why the Trump administration is doing this, and we'll get there in just a second. Before though, I asked you a version of this question in our live stream yesterday, Lance. But so a lot of people have been worried about tariffs, saying that they're going to be inflationary. You, in the past, have countered that. But if they get passed sort of as is currently constructed, yesterday, as we talked yesterday, I think you think, hey, those actually really could be, they're definitely going to raise prices. So let me ask you this: if things were to stay the way that they were, what do you think would summarize best the era we'd be entering into? Would it be inflationary? Would it be stagflationary? And I know stagflation is a very specific definition for you, but meaning like potentially really high prices and going into recession with unemployment going up? Or is it really going to be more disinflation and deflation carry the day because of a recession?
Well, it's so, there's a lot of variables that have to kind of work themselves out. So let's just kind of walk through each one. So assuming tariffs stay exactly the way they are right now, right, which are onerous to a large degree, they're not going to be inflationary. They're going to be deflationary. And the reason they will be deflationary is because nobody can deal with prices where they are. Corporations can't deal with them because that impact of that higher cost coming in, if I can't pass that on to the consumer, I can only make a couple of decisions. Either A, I don't buy whatever that product is, and I source it somewhere else at a cheaper price, or I make a lot less of whatever item that is that's coming in, and because I can't sell it anyway. So there's an inventory imbalance. And right now we saw a lot of companies, if you take a look at inventories, been a huge surge in inventories trying to get ahead of these tariffs. And now companies are going to be forced with facing two things: one, which is a slowing consumer, and the inability to pass off those tariffs. And now I've got all this inventory, I've got a discount to sell. So that in that environment, and then the bigger factor of that is business investment. So when you take a look at GDP, about 15% of GDP is business investment. And so if I'm being impacted by all these higher costs, I can't sell my product. I'm happy to talk about laying off workers here because of a slowing economic environment. I'm certainly not going to be doing CapEx spending. I'm not going to be spending money and doing, building out a new property plant, or, buying new equipment, producing more inventory, whatever it is, because there's no demand for it. So that's going to impact GDP. Consumption slowing down, that impacts GDP because of personal consumption. All that's deflationary. So that all drags prices lower, because again, at the end of the day, what's inflation? It's supply and demand. I may have higher input costs, but if I can't pass it on, there's no inflation from that standpoint. So we may see inflation on the producer side, but not on the consumer side.
Okay. All right. And just for the folks watching this, again, this could all get undone tomorrow with a couple of phone calls. Yeah. But if it doesn't, you really feel like it sounds like you think odds are good. This will really feel like a recession, the further we go into this year, in a way that it hasn't felt like a recession for the American consumer in a long time. Like, we can argue that, part of the population's been in recession over the past bunch of years, and I'm sympathetic to that argument. But we've had the top echelon really pulling things up. Given the type of future you think we could go into if these tariffs stay in place as is, it could really feel like a recession the way that '08 felt like a recession, the way that the early '90s felt like a recession.
Well, no, so a little different. The answer to your question is yes. It's not going to feel like a recession. It's going to be a recession,
Okay.
right?
But
So
I mean, feel like a recession, like, okay, I'm afraid of losing my job. I lost my job. Like, I mean,
yeah,
all that type of really hard stuff.
yeah, no, and so yeah, it's going to be a recession. If things stay where they are, we're going to be in a recession, right? There's almost just no way around that at some point. Because we don't have any financial stimulus flying around anymore, right? We're not sending checks to households yet. The Fed's not doing not doing QE. Now they did reduce QT. We don't have, QE coming into the markets. We don't have, some big spending package on the horizon. We don't have a big tax cut package on the horizon. So there's nothing to offset all of these tariffs yet, right? So again, just taking things in isolation, looking at today, if everything remains the way it is today, right now, we will be in a recession in 6 months, maybe not. Because while the upper echelon has been supporting 50% of the growth of the spending in the economy, they're not going to want to pay dramatically higher prices. And when capital markets are peeling apart like they are now, if that continues, they're going to start contracting spending just like everybody else is, just from, hey, you know what, I need to maybe not buy that plane this month I was thinking about
Right.
because
Well, but that's why the negative wealth effect matters here, sadly,
it
is
does.
because it's that affluent echelon that's pretty impervious as long as stocks are doing well. Now, when stocks are getting clobbered like they are, they look at their statements and say, "Whoa, wait a second, I got to really downshift." Yeah.
That's right. And so yes, it will be it won't feel like a recession. It will be a recession. It'll be different though than the financial crisis. Again, when you have a credit related crisis, that's a different environment than, and even to a large degree, the dot-com crash was credit related, right? We had failures of Enron and WorldCom and Global Crossing and Lucent and all these others. So, those are different environments. And so a recessionary environment like this may be more like an 87 type issue where it's fairly short lived. You have negative GDP growth of 1.5% maybe, short lived for a couple of months, but somewhere in that phase, the Fed's going to step in, slash rates to zero. They're going to start doing QE. We're going to start getting, whatever tariff policy there was, there's going to be a retraction. Everybody's going to start running in reverse to try to get out of the recession, right? So it will be a recession. It'll be fairly short-lived unless this morphs into a credit-related event of some sort. And there's certainly enough debt out there in terms of corporate credit, et cetera, that's certainly not a risk that's not entirely off the table. It's a fairly low probability event right now, but it's not entirely dismissive.
Okay, it might be a little bit of a higher probability, and I don't know, but I just want to note, and we'll talk about this more hopefully a little bit later in this discussion. I'm just coming off an interview with Anna Wong, chief economist at Bloomberg Economics, who before yesterday and today's big market drops, she had said, "Hey, look, I actually think that we're probably heading into recession." And she said it wouldn't surprise me if the S&P were down, 30% from here, and it's already made a lot of progress in the past 48 hours towards
Yeah.
that goal. But she said, "Look, and one of the big reasons why she's pessimistic about where the economy is headed is because of her concerns about the credit worthiness of the American consumer. And she believes it's actually lower than most lenders appreciate right now. And she thinks as that gets discovered, it's going to manifest in some credit issues. Now she's saying, I'm not predicting that this is going to be the next subprime that's going to lock up the credit markets the way that happened in 2008, to your point, Lance. It's not a credit crisis, but it could be a rolling, a grinding credit event. Events maybe too finite of a word, but a grinding down of the credit markets that could create a more prolonged recession and be credit related, right? Again, not an '08, the whole system dies, but
Well, yeah, and what you need though, and yeah, I'm not disagreeing with her because again, if you get into a recessionary event of magnitude, you're going to impact credit, right? I mean, and so look, let's just step everything back for a second.
right.
What is a recession, right? Recession is slower economic growth, job losses, people can't pay their bills. You know, what we don't have today, fortunately, what we don't have today, we don't have an environment like subprime where we were giving out a lot of money loans to very uncreditworthy borrowers. We do have some of that risk in the collateral loan market. We have some of that risk in the high yield market. Obviously, we've got that risk in the
Commercial
Russell
real estate.
2000 corporate debt market. Yeah, but those are fairly small pockets. You know, one of the pockets I'm watching really closely is this buy now pay later credit.
Yeah.
But even that, it's if you look at the buy now pay later universe as a percentage of the global bond market,
It's tiny.
it's teeny tiny. So even if it completely blows up, it's certainly going to impact the lenders that are backing, a firm and what's the other one, Klarna, which is about to go public. It's certainly going to impact those, but it's not going to be one where all of a sudden Klarna blows up and JP Morgan's going out of business. That's not going to happen.
Right, right. No, and I don't think Anna would say that as well. Her issue is that we had all of these things that were propping up the bottom of the consumer, the bottom echelon of consumers. It was the checks to the households. It was the moratorium on having to pay their mortgages or their rent. And it was the moratorium on student loans. And now all of those are gone. And student loans are now the last one to really go back into repayment. And I think it's like 30 or 40 million borrowers, but it's about 10 million of them are kind of in the danger zone, from what her data shows. And what she's realizing is that, not only are they going to start being delinquent on their student loan debts soon, but they're going to be delinquent on other forms of debt as well, right? And she also talks about how credit scores, it's almost kind of like grade inflation in the academic system. She's like, credit scores are higher than they were in 2008 or pre-2008. And so people say, well, the consumer's in better shape. She's like, actually, if you adjust it for sort of the grade inflation in credit scores, it's really about the same. And so it's interesting. She says it creates this interesting issue where there's now information asymmetry, where the lender actually thinks the buyer is more creditworthy than they really are, and the buyer knows their own, or the borrower knows their own true creditworthiness. And so they might be like, hey, look, I'm struggling, so I'm going to go out and make as many loans as I can get, right? Where the lenders still think I'm a pretty good credit, even though I know I'm not, right? So she says, as the lenders start to wake up to that, as more and more people become delinquent, being pushed in by their student loans, then the lenders are going to start, tightening their lending standards, and then you could potentially start getting this contagion that starts spilling into all forms of debt. And again, she's not predicting apocalypse, but she's saying that could really be enough to really start crimping consumer spending. And this was all pre-Liberation Day too. I should just be a little clear about. Yeah.
No, I think she's absolutely right. And again, that would all be very coincident and what you would need for a recession. And that's very deep. And again, going back to for instance, when we started this out, I told you Jerome Powell was speaking, while we were doing this. And, he's talking about that he sees Trump's tariffs being inflationary and that he's going to be looking at, policy according to kind of what's going on. So they're going to pause and wait and see here kind of how this all works out before making their next decision on rate cuts. And as usual, the Fed's going to be behind the curve on this.
Mm-hmm.
But, where Powell's about to get himself into trouble is that the impact of, if this drags on much longer, the impact to the consumer, this is very negative psychologically. Again, what drives spending, you just said, is psychology, right? It's just, I'm aware of my finances, so I may be able to go, well, I'm about to go bankrupt, so I'm going to go spend a bunch of money right now. But that's it's a very short-lived impact. And what the Fed's going to get trapped into is all of a sudden we're going to see this data start to pop up that's very recessionary. The consumer's contracting sharply. So demand is declining within the economy, which is going to force liquidation of inventories at discounted prices, which is disinflationary. That's going to push yields down, and the Fed's going to have to cut rates into that, which is the worst possible scenario for the Fed because now they're running behind the curve
Right.
trying to bail out the economy.
And their policy acts with a lag, right?
Yep.
So, if they're not doing a big QE program or whatever, it's going to be months, quarters before we even see
Yep.
any benefit from this. And just to show folks how volatile markets are right now, when Lance and I started talking, markets were down like 4.8. About 20 minutes ago, they'd gotten back down to about 3 flat, and then Powell started talking, and now it's S&P's down about 410 right now, 4.2 right now. So
Yep.
it's just whipsawing all over the place. Okay. All right. Well, look, let me get into kind of the big theme of the day, I think, and I'd love to get your thoughts on this, Lance. And folks, let me preface this by saying I am not taking a partisan position here. I'm deliberately going to try not to say whether this is good or bad or whatever. I'm just trying to explain it as best I understand it. I spend a lot of time these days listening to President Trump and the members of the Trump administration when they talk about their economic policies. One of the things I will praise this administration for is they are in front of the camera all the time. So to the extent they're telling us what they truly think, we know how they think. Whether we like what they think or not, different story. But I guess the big point I want to make here, Lance, is I think Trump and the Trump administration, I think they are on a war footing here. I think that they literally see what they're doing as like their version of World War II, that they have a big goal, a big objective. They're fighting it on multiple fronts. And this is not something that they're just trying out to see how it goes. Oh, and if, sentiment's bad or feedback's bad, we'll change and react. I think they are saying, look, we are trying to accomplish a big mission here, and we're in it for the long haul, right? And so I think a lot of people think Trump's kind of making this up as he goes along, and this guy, wakes up in the morning and changes his mind 9 times a day, and he's just a spinning, whirling dervish that's just kind of, doing things randomly. I don't think that's the case. Again, I'm not going to say whether I agree or disagree with what he's trying to do, but I think that he came in with a very clear agenda. He picked specific leaders to execute that agenda for him. I think they've got their marching orders, and I think they are fully committed to it. And so the reason why I think this is so important to understand is if you're, expecting this to ease or to abate or to change or for Trump to get scared and then, retract, I think the odds of that might be a lot lower than most folks are expecting.
I agree with that.
And let me just go through a couple of things of what I think the main objectives are, and then also to sum this up.
Sure.
So they are out, especially with Liberation Day, right? It's all about rebalancing global trade, right? And what does that mean? Well, they feel the U.S. has been getting a raw deal, right? Trade-wise. Again, we can argue whether that's right or wrong. It's addressing tariffs, but more importantly, his team is saying it's not the tariffs themselves, it's what they call the non-tariff trade barriers. So these are things like what the U.S. perceives to be unfair regulations that are keeping U.S. products out of these markets, or whether it's subsidies of domestic players versus what the U.S. could do inside that country. So this might be like the country has a VAT tax and is taking the proceeds from that VAT tax and subsidizing their auto industry with it, or using it to subsidize energy and provide cheap energy so that, say, the country can make steel, at prices that the U.S. can, right? So they're basically just trying to say, hey, look, we feel we're getting, the playing field's not even. We've been operating this way for decades and decades. In fact, we don't even blame the countries that are quote unquote screwing us. They're just getting away with what they can get away with. Trump says, I blame my predecessors, of multiple different administrations, and I'm here to right-size things. They also think that, look, the U.S. is the biggest market in the world, biggest consumer market in the world, and kind of like Costco, there should be like a membership fee. If you want to play in our market, there's at least some minimum you should pay, and then we want to demand that you guys, if above and beyond that, the field be as level as possible. So they're trying to right size that, rightly or wrongly, but that's what they're trying to do. In addition to that, they're trying to drive investment in the US, really to fund a new manufacturing era here. So these are the deals you're hearing Trump, already begin to announce. The $1.5 trillion from the United Arab Emirates, the 500 million from Apple, the 500 billion from Apple, the hundreds of billions from NVIDIA, the 100 billion from TSMC, right? This is trying to get foreign companies to say, hey, look, you come play with us, we'll actually give you favored terms, right? The best way not to get tariffed by us is to build your products in the US to sell to our our citizens, right? And you employ our workers to do it, right? And that's, whether you think that's good or bad, that's definitely a big part of his agenda here. So in addition to that, they're laser focused on spurring economic growth here in the US. And that's through lowering taxes, that's through deregulation, that's through increased investment, like some of the deals I just talked about. On the other side of the coin, they're trying to cut costs and to begin to get their hands around the debt. This is through DOGE. This is through ending what they consider to be global subsidies to the rest of the world, like the support we've been giving Ukraine for their war, the checks that were being written by USAID, paying for Europe's defenses, and now saying, look, EU countries, you get to pay for your own NATO contributions going forward. Working through Congress to try to get the deficit under control through continuing resolutions, stopping illegal immigration and having people coming in here that then get on the social support programs. The other thing that's really big for them is national security. So that's, stopping fentanyl from coming in the country, as we've heard a lot. They want the US to start making critical ingredients that it does not make today. You've heard a lot of talk over the recent days about how, we don't make many of our pharmaceutical products. Obviously, we haven't made many of our chips for AI, and that's now a big priority. So a lot of this is sort of reshoring what they consider to be essential commerce for the country. They understand that there's a debt crisis here, so a big part of everything they're doing, is to try to get the debt under control, like I said earlier. And of course, for security, there's also, getting criminals out, and that's a big thing that they're doing right now with the deportations and beefing up law enforcement. So kind of at the end of the day, they're saying, look, we've been kind of supporting the rest of the world. It's now time for us to put American citizens first. And so this is kind of the key takeaway here, where the way I think Trump looks at this is an Atlas Shrugged moment, where he's basically saying, we've been unfairly supporting the rest of the world, and we're now realizing, why? Sure, it's important to us to have good relationships and preserve democracy in other parts of the world and all that stuff. But at the end of the day, we got to put our people first. And I think this is Trump shrugging. This is Atlas shrugging and saying, look, rest of the world, you're going to have to do you're going to have to take this weight going forward, or much more of this weight than you were. We're really going to focus on the American prospects right now. And what's interesting about that is it's like calling everybody at the poker table, right? Where everybody has to put their cards down, and it's like, you're either going to have a better hand than me, or you're not here. And I think at this point, Trump feels like he's just got the best hand. And for most countries, Lance, I'd love to hear your thoughts on this. What is the option, right? I mean, you can try to fight back. You can try to create a coalition to push back on America here. But is there anybody here right now that can really get along without access to the American market? Is there anybody that has a stronger hand right now than we do? If you're going to play a game of Outlast versus America, can you win?
I don't think we have, in that setup that you just put between other countries and us.
Yep.
We're very heavily dependent on international trade. I mean, 40% of corporate revenues come from exports, right? So, we can't manufacture televisions. We can't manufacture blue jeans. We can't manufacture a lot of these things that we need. We import all that stuff. So we're not in that enviable position of say, hey, you know what? We really don't need anybody. We can produce, we can. I mean, we actually have the ability to produce everything we need right here in the States. We really don't need much. But that would take years to develop. We're not in that position today. And, so if if I was going to do this and I was president, I'd say, look, we're going to focus instead of these tariffs. I would have gone, hey, let's just focus on building our internal structure. We're gonna focus all of our efforts, reduce our debts, reduce our deficits. Those are fine. But you're not even really having great success at that right now, because every time you turn around and try to cut spending, you're getting some lawsuit coming up from some federal judge blocking the deportation of individuals, or blocking blocking spending cuts, or blocking the termination of federal employees. So, that he's making some very minor progress in that area. But again, everything you're trying to do is, you're getting blocked at every turn, and then you turn around and do these exorbitant tariffs, which, again, I'm supportive of the administration, but he made a mistake, and that's the only way to classify this. And if you're President Trump, you've got to acknowledge, hey, you know what? I did this. I was taking advice from the people I hired as counsel. They came to me, Howard Lutnick, whoever else came to me and said, this is the way to do it. I took their counsel. I took their advice. Clearly, I'm incorrect. And we need to step back and put a pause on these tariffs for the time being and rethink our strategy. This is still something we want to achieve, something we're going to achieve, but we need to rethink how we approach this. And then, kind of go back to the drawing board and start over and make the right thing. But this is akin to kind of cleaning a loaded gun, right? I mean, you may get away with it, but there's a risk that you won't. And in this case, it looks like this was a risk he's not going to get away with.
Well, and okay, this is the crux of my point here, which is, I know you think that's what he should do, and it very well may be what he should do. Who knows, right? And again, personally, I think this is just an opening salvo for Trump, and it's so all his people can point and say, this guy's really mad and crazy. Let's negotiate something better. But whatever. Let's say, though, it is the fact is, it is what it is, right? So let's say Trump just doubles down on this thing, right? That's the world that people have to live in. And to your point about, okay, yeah, we don't make our TVs, we don't make our blue jeans. Yeah, you're right. But those countries that sell us blue jeans and TVs, can they do without selling that to us? Can they have those products be absorbed by demand around the rest of the world with no problems? I don't know if they can. The U.S. is such a big player here.
Absolutely.
And there's also, just make this point, and then you can react to it.
Yeah.
Sure, the initial response of all these countries, very understandably, is going to be ignominy and anger and frustration, right? And there may be a sense of all right, let's retaliate, or let's bind together and let's all agree to become our own trading bloc or whatnot. There's a pretty big, benefit to bolting from that herd early and cozying up to America and saying, hey, you know what? Let's work out a deal, right? I know those guys are angry with you. I'm going to be your buddy. Let's work out a deal here, right? And so, I think once countries start doing that, the ones that are holding out, the question is can you? If people start lining up at the trough and getting great deals, and you're getting iced out because you're, just trying to stand on principle, can you do that? And I think that's the bet that Trump is making here, where he is saying, I have got the best hand at the table, and I basically can just push these guys into it. And again, I'm not saying this is good. I'm not saying it's bad. I'm just saying, I think this is and I think he's looking at it like a war footing, right? It may be years before I'm proven right on this, and I'm willing to wait that long. So I think part of this, Lance, you and I talked earlier about how if we were him, we would say, hey, I got this crappy economy, and everybody get ready. We're gonna have to tighten our belts. And it would, if there was a recession to come, the sooner it comes is the better for him, so that maybe by the midterm elections, we've bottomed and are beginning to show signs of progress again. And then he can say, hey, everybody, look, I was right. We had some rough times, but now everything's starting to get good, right? And so this may be part of that, war footing campaign. All right, I'm going to let this thing rage for a bit, and it's early on enough where I still have good enough ratings. I can deal with some souring sentiment. I can deal with some pain in the stock market, and maybe even I lose the midterms. But I got enough of the stuff I needed to get done early on in my administration, that the benefits finally manifested in years late 2, 3, and 4, right?
Yep, and it could very well be the case. I'm not sure that Trump has the staying power for that, in terms of, just his personality. There is a bit of personal ego he has to deal with. So is he willing to stand in front of this train for 6, 8, 12, 14, 18 months, 24 months, go through a fairly deep recession, lose the House and the Senate in the upcoming midterms next year, which basically makes him a lame duck president for those last 2 years that occurs. So again, he's got about 16 months to get this to work. And so, maybe you're right. Maybe these other countries start lining up at the trough and saying, hey, I'll cut a deal with you to get this done. Because, a fair point, which is that these countries, a lot of them are very, very dependent, emerging markets in particular, very, very dependent on the US. We get a cold, they get the flu. So, they are very dependent upon, their economies are very dependent upon the US for their livelihoods. So again, this is early right now. I mean, it's only been a couple of days that this has happened since Liberation Day occurred was Wednesday. So, we're very early into this, and by the end of the next week, hopefully, we'll have some kind of breaks in some of this, and we'll kind of get to start to see some of these, negotiations starting to play out favorably for the U.S. And if that occurs, this market should do very, very well going from there. Certainly alleviate some of the short-term pressure, at least.
Well, you know who's going to be first at the trough?
Who?
The Penguins.
The Penguins.
They're going to break
lining up.
first. Yep, that's I'm placing my money on them. And look, we're speculating. We could be wrong. I'm just saying this as somebody who's been listening and watching this team really closely. I see them as having that sort of war footing level of commitment that it's going to be rough, that they are going to take fire, both foe driven and friendly, but that they're going to win in the end here. And who knows? Maybe not. Maybe you're right, Lance. Maybe there's some moment there where Trump just blinks and his ego makes him reverse it all. But my point is just that everybody thought coming in, he was going to be like Trump 1.0, where at the first sign of a wiggle in the market or something that just made him look bad, he was going to reverse and try to talk about how great he was. I think it might be a different guy this time, and therefore you've got to just be aware of this potential if you're expecting him to blink.
Yeah, no, and absolutely, that's absolutely true case. One thing that I think he needs is somebody that is willing to stand up to him and say no. That should be a guy like Howard Lutnick, who won't, unfortunately. Scott Bessent won't. And you need guys in those positions in particular that will say this is not good policy, or this isn't the right way to approach this. This isn't the thing to do here. We should think of a better strategy. Scott Bessent has just made 2 very bad statements over the last few days, just kind of really just trying to appease his position with the administration rather than saying, look, here's an issue. We're aware of it, and we're going to work through it. And I am working directly with the president to try to come up with a better solution. That would have been a much better statement from Bessent and for the markets than the ones he made. Yeah.
Well, and again, I think that's part of because they've agreed on the war plan and they're lashed to the mast. So we'll see.
And that's part of the issue. Look, I made a mistake recently. I bought Arista Networks. We sold it, unfortunately, at a fairly decent loss, but that happens sometimes. But we made a mistake, right? And that happens in portfolio management. The problem with the administration is I don't think they have the ability to stand up and say, we made a mistake, we got to fix this. And that subjects potentially the economy to much more of a negative impact than it would necessarily need to be otherwise.
Yeah.
I mean, this is a fairly easy fix, right? This is a fairly easy fix to come out and just say, hey, look, you know what? The way these tariffs were calculated was incorrect. We need to come up with a better negotiation, whatever. However you get there, but at some point you just got to say, I made a mistake, and then try to fix the problem.
Right. And he may. I don't think he will, at least not anytime soon. And there's this tweet here from Bill Gross. I just want to get your reaction to. So this is an epic economic and market event similar to 1971 and the end of the gold standard, except with immediate negative consequences. Trump can't back down anytime soon. He's too macho for that. So, to me, this means Bill is sort of thinking similar to me, which is this is not just a trial balloon type of thing. This is like a crossing of the Rubicon. Or feels like the crossing of a Rubicon. It seems like Bill sees the same thing. He also says, from an investing standpoint, investors should not try to catch a falling knife. Today's appealing bargains will be around tomorrow and the next day. And it says here that buying domestic companies such as AT&T and Verizon for relatively safe dividends in a falling interest rate world probably makes sense. But even with these, be careful as they're approaching overbought territory.
Like, for instance, in our dividend equity growth model, we own Verizon, we own Philip Morris. So, that's right. Don't listen to Bill Gross, though. He's been consistently wrong for the last 10 years. So that's one of the worst guys to take advice from in terms of managing your money. So I would just completely discount that one altogether.
Okay. Out with the old bond king, in with the new bond king, Lance Roberts.
No.
Or Mike Leibowitz.
He's just been terribly wrong on his calls. Back in 2013, he was like, interest rates are going to 5%. They went to almost zero. So, he's consistently, and that's why he's no longer with PIMCO, by the way. He's just been consistently wrong for a very long period of time. And that's, he was once the top of his game in the bond market. He hasn't been that way in a long time. So, just be careful when bond people are giving you stock instructions.
No, that's actually a good point. Okay. Well, look, Lance, obviously the game has changed a lot here in recent days. How does this change RIA's strategy, if at all?
Well, we're about to trigger our big sell signal, right? Yes. So that's going to occur today, most likely. We won't know till after the close of the market, but it will most likely either trigger today or first part of next week. And so what that suggests is that we need to reduce equity risk further. But that doesn't mean reduce risk now. Historically, when you get these signals, they typically occur when the market is deeply oversold. And right now, the markets are 3 standard deviations oversold by a large degree. I mean, we're very deviated from moving averages. We're sitting on supports that go back a decent ways. So you've got this extreme negative sentiment, extreme negative position. So you're going to get this sell signal, and then the markets are going to rally. And the markets, for whatever reason, the markets are going to rally. Some piece of good news, the Fed says, hey, maybe we need to talk about cutting rates, whatever. So the market rallies, we're going to get to 56, 5,700 there. People are starting getting very bullish. You're going to start getting really bullish headlines. Tom Lee's going to come out and tell you that the bull market's back on. Ed Yardini is going to come out and tell you the market's going to 10,000, whatever. And when that occurs, that's where you want to sell. Because most likely you are going to have another down drift in the market simply because the economic data is starting to slow down. You've got a lot of trap longs in the markets. They're looking for an exit. So they're going to exit the markets. You've got a lot of overhead resistance now. You've got these longer term moving averages now crossing over. So that's now a big overhead like resistance level, like a ceiling that stocks are going to have trouble getting above. And then you get this next decline. And as I wrote about in this week, is that I think what we're starting to set up for is something very similar to 2022, where we have this playbook where the market declined, it rallied, it declined, rallied again, declined, finally set the bottom, and that was the bottom in October of 22. But I think you get this stair step down over the course of this year as we deal with slower economic growth. Now, this is all assuming that we don't have a financial event of some sort crop up, right? It's just a normal recessionary kind of drawdown in the markets. And, back on January 7th, we wrote this article called Curb Your Enthusiasm, talking about, expecting no returns this year, higher volatility. Well, here you are, right? This is exactly what's happening. So again, I think you get this rally, you sell into that rally, wait for the next decline, and then you can start kind of trying to add some exposure, stuff that's getting truly oversold, really deeply undervalued. There's going to be a lot of stocks like that. And you'll have a much better entry point to start building equity exposure back into your portfolio. And when we get to the bottom of this decline, that's probably going to be a point of where we reduce our bond exposure and overweight equities at that point as well.
Got it. All right. So, sorry, just so I understand, though, it sounds like you say you're probably today going to trigger the signal that says, hey, we should bring our, cash percentage of our equity allocation up by 25% or whatever. You have those 25% moves, right? Yeah.
Yeah. So, well, and again, it doesn't mean we do it all at once, though. It doesn't mean we go 25% cash today. we sold ANET today, so there's 2%. On this rally, we might sell 1% of 10 positions, right? And we're already at 12% cash. So all we got to do is raise 12% cash. So, that's how that would happen, but that would happen on that rally. So again, this is the history of those sell signals kind of going back. And, if we just kind of zoom into this over the last 10 years, but just kind of looking here near term, the market's getting decently oversold here. We're at 20 on the weekly RSI, or 30 on the weekly RSI. Normally, that's where markets at least temporarily bottom. So this is 2022 right here. So this was the initial sales. Let me back this up just a smidge so we get the entirety of 2022 in here. So here's the peak of the market in 2021. We started selling off, triggered the sell signal. Then you see this big rally in the market. It's actually got above the moving averages, right? So everybody got very bullish at this point. Said, oh, the bull market's back, and then drafted lower. We then had another big rally back to the moving average, failed there again, and then you set your bottom in 2022. I think that's a very similar playbook we have this year because of this draft we've had on a weekly basis. This is a very large decline over a 1 week period. So you get this rally back, fairly substantial. Again, 55, 56, 5,700. Again, don't pick a number like, oh, when we get to 5,700, I'm going to sell. No, not the address. We're not looking for a specific house in the neighborhood. We're just looking for the neighborhood, right? So we're on I-10 heading into Houston. When you see the city limit sign, start selling, right? I'm going to see Adam. What big city you live close to, Adam?
Santa Rosa.
Okay, so when I start seeing the city limit signs,
San Francisco. San Francisco. That's a good time to start selling.
When I see the high rises of the San Francisco skyline, start selling, right? I don't need to be into. Yeah, so that's the point. But somewhere in this range, start to reduce some exposure. I think you come down, you're at least going to retest these lows at some point. Maybe not set a new low, but at least probably retest these lows before this is all over. And then we see this market kind of start to heal up, and we'll begin to see this cross. Now I want to back this up real quick because I want to show you something important. Not every cross is a major mean reverting event. And this is important to consider. So let's take this back 35 years, for example. So if you go back in history, there are periods where these crosses have been consistent with major bear markets, the dot-com crash, the 2008 financial crisis. So it certainly could be indicating that we're going into a much larger corrective cycle. However, there's a lot of times, particularly over the last decade, that these crosses are short in nature, and these are more event-driven issues. So this first one on the left. This was the end of QE1 and the start of QE2. The second one was the end of QE2 and the beginning of Operation Twist. This third one in 2015-16 was Brexit. Very specific events. Then you had the Fed taper tantrum in 2018. Very specific event. Once it was over, it was over. Pandemic, big correction, and very quickly crossover, sell everything, get back in the markets a couple of months later. Specific event driven. The decline in 2021, bit different because it was the Fed was hiking rates. We were worried about recession risk. It never happened, but we were worried about a recession, had the Russia-Ukraine thing going on. So that took a longer period of time. Given that this is an event-specific event without a recession yet, this could be fairly short-lived. We could see the sell signal pop down, and in 3 months, we're back on a buy signal and, overweighting equities. I'm not saying that's the case, but again, don't just assume that just because you get this signal, you should sell everything and go to cash, because that could leave you really sitting on the sidelines for way too long trying to figure out how to get back in.
Yeah, and that's going to be the toughest thing for a lot of people, right? You said that psychologically, once you've moved to cash, it's hard for most people to get back into the market. Then the market moves, and then they think, well, it's gone up, surely it's going to pull back, and then they just sit watching the thing keep going up. So folks, try not to get paralyzed in that state as well, but obviously, prioritize defense and safety right now. All right, I meant to mention this earlier, but Lance, when we were talking about the risk of the heightened risk of recession this year, I just wanted to remind folks that I finally published my updated version of the Layoff Survival Guide, which has, I think, some really helpful information for what to do before you potentially get laid off if you work for a paycheck, and then definitely has some steps you should take immediately upon learning that you get laid off if you're unfortunate enough to have that happen. And so if you haven't read that yet, folks, just go to thoughtfulmoney.com/layoffs. It's totally free. Highly recommend that you just at least, print it out and just put it in a drawer somewhere. Hopefully you'll never need it. But probably worth everybody who works for a paycheck reading at least the first half of ways that you can hopefully just reduce your odds of getting laid off during tough times for employers. All right, Lance. All right, I guess let's go to trades. Have you guys been making any trades in this carnage, or are you just sort of hunkering down?
Well, basically, we had already taken a lot of profits and stuff. Like we reduced our energy exposure going into this because we were worried about the impact on oil and gas and oil prices in general. That's paid off well.
Paid off well because oil's gotten clobbered.
Yeah, and which is also another problem for Trump's agenda as well. Drill baby drill may be more like hold baby hold, because not necessarily profitable to drill at these levels. But we'd already done a lot of profit taking. I wish, in hindsight, sure, wish I would have done a whole lot more. But we had our bond exposure, which bonds have been doing a great job of hedging, the hedging portfolio risk at this point. We did sell, like I said, we bought ANET not too long ago, but bought it too early and made a mistake there. So we closed that position out. So we'll probably wind up buying it back at some point. We got to wait 30 days though for that, for the tax loss sale. But again, there's some things that we'll be doing over the course of this next rally. We'll certainly reduce risks more. So more of the trades will occur on a rally versus the decline.
Okay. Well, those are the more fun trades, right? Where you're hoping that things are going to go up. So let's hope we get there sooner rather than later. All right, we might have time to get a rant in. I've got a quick just channel update for folks too. I'm going to give in a second. But first, just I noticed that RIA on your website, Lance, you guys published, your personal finance team published a new guide to estate planning.
Yes.
And highly recommend folks go read that. It's good. That's definitely a great resource. I just want to tie that to a call I had this week. A couple reached out to have a consultation with one of the financial advisors, and they were sharing their personal situation with me. And sadly, it was a couple, older couple, where the gentleman has a terminal illness. And I don't know if you may be watching or not, but if you are, sir, I really do wish you all the best, as we discussed. So this gentleman, is doing the right thing. He has been the principal handler of the finances in his relationship, and his spouse has not been involved. And he is realizing he's not going to be around to be the steward of their financial prospects. And so he's now looking to find a financial quarterback that he can hand the baton to, hopefully in time, with enough time so that he can really get to know the right advisor, pick the one that's philosophically aligned with him, but also give his spouse time to develop a relationship with the advisor so that on the sad day where he can no longer attend to their financial affairs, the spouse feels like she's got a good team around her that she feels comfortable with. And I've mentioned this many times before on the program, but this conversation really just hit it home again for me again, which is I know a lot of DIY investors watch this channel. I know most of you are north of 50 years old, and I just know this from the surveys that you all have answered for me. And that is fantastic that channels like this help you become more informed in making hopefully better investment decisions. But if you are somebody like this gentleman, where you're basically the one owning this responsibility for your family, and you don't have somebody already identified as your clear successor to taking over this responsibility should something happen to you, then it really is one of the most, I think, essential steps that you should take in the near term is to try to identify who that is. If it's a family member that can take over it from you, great. Make sure that they're willing to do it. Make sure that you're starting to really bring them up to speed on what your process is and that they know how you like to have your assets invested. But if your family says, hey, wait, no, that's not me, I don't want to do that, and that's a fine answer, then say, okay, great. If it's not them, then who is it going to be? And identify that person now. And again, build the relationship with the people who you're going to be leaving behind so that everything is taken care of, which you absolutely do not want to see. And I've seen this happen a lot, but Lance, I'm sure you see it all the time, is where the person who owns the financial responsibility does get incapacitated or passes away, and the family is just devastated and they have no clue where to go. And a lot of times what happens is that's where sort of the predatory players start coming in, right? And oh, it's a widow, let me tell her to go work with our fly-by-night firm, and all of a sudden they find out months later that they partnered with a really bad firm, but they didn't have the financial expertise to know how to make a good decision, and they were making decisions at a very emotionally vulnerable time in their lives. It's just a bad formula. So I want to give you a chance here, Lance, to reiterate the point I'm making here, because I'm sure you see it even more than I do.
Well, I mean, yeah, we talk about this all the time, is that, most of the people that we deal with in terms of clients is that the husband's kind of in control of all the money, and the wife, so it's like, I don't know what's going on. And they don't know, kind of where anything is. They don't really know what's going on with the portfolio. And so one thing that we do in our shop in particular is that we have a lot of events all the time where, like, we've got a crawfish boil coming up here soon. And just recently we did a batting cage event, and we do all these, we had an event at a company that makes handmade boots. So you actually go see them make boots and stuff like that. So we have these events to try to get husbands and wives in the same place so that we can talk about, hey, what's going on with your family, blah, blah, blah. These are the things. And we're trying to do more family events now too, where like the parents bring their kids, or if their kids are adult kids, the adult kids bring the grandkids to these events as well. So we get to know the whole family, because the big problem is that when the husband passes away, there's no relationship in a lot of cases. And so the wife doesn't know where to go, and the obituary gets posted. And and look, there's you hear about ambulance chasers in terms of lawyers. There are obituary chasers in terms of financial advisors. They look for those obituaries, and they go hunt down the widow of that person and say, oh, I'm so sorry for your loss. You need to buy an annuity. And, they just sell them an annuity product or whatever it is, because those are big commission items. So it's very important that, if you're trading on your own, doing it yourself, make sure that your spouse is involved in the process. You should have a monthly board meeting with your wife and sit down and say, here's what happened in the portfolio this month. This is what I'm doing. She may roll her eyes and say, just try to bring her back to say, look, I made this much money. That means you can go buy a new Louis Vuitton purse, right? So give her some incentive to be involved with the process of what you're doing. Give her some, not only some input, but give her some benefit from all this stuff that you're doing, so that she is involved. And that way, when you do pass away, she knows who to call. Like my wife knows, like my wife is very typical. She doesn't care about the investing side of this. Unless it's her own 401k account, then she's very interested. But, on all the stuff that I handle for the family, she's like, yeah, I trust you. You do it. I go, but honey, when I die, what do you do? She goes, I'm going to call Danny. And I go, there you go. So she knows.
She's got her backup identified. Yeah.
Yeah. But that's our whole backup plan is I'm going to call Danny. I go, well, what if Danny's dead? And she goes, well, then I'm just screwed. So, but the point is that you need to have that in place of some sort. And I made a comment on our radio show about last week. I was visiting with Danny. I said, I'm very disappointed in you, Danny. And he goes, why are you disappointed in me? I said, because this book just came out on the marketplace, and you should have written it. And it's called Sorry, It's Your Problem Now Because I'm Dead. And this is just, and we've talked about this before, writing a love letter to your family and putting that somewhere with, a binder that has, your account numbers, passwords, all those type of things in some place that's easy and consolidated. Adam will tell you this, when you have to go through a family member's life and try to get it organized for tax purposes and estate planning issues, those are, it's a drag to start with, because you just lost somebody important, but now you go dig in all their personal stuff, trying to piece together the jigsaw puzzle of their financial life for the estate planning and, probate, whatever it is. If there's no will, that makes it even more complicated. But a simple book like this can really help. It goes through and talks about your financial information and kind of putting all your stuff together in one place so that it's easy to organize and easy to locate. Just all different kinds of stuff. So again, it's $11. I mean, on Amazon. So again, it's those are simple things that you should be doing, particularly if you're doing it yourself, which is completely great. No problem with that. But at least take some of the time to put this together and make sure that your spouse is involved, because again, it will make, it's not just making things easier on your spouse when you pass away. It's also making sure that they don't get victimized after the process, because we see more individuals than you can imagine that are sold bad products or sold, things that they shouldn't be in because they're high commission products, et cetera, because they didn't know better. They were just, in the moment of grief, they're approached by somebody who says, "Oh, your husband just died. You better do this with your money, or there's going to be this huge IRS tax." There may be no taxes whatsoever on the issue, but they don't know that. And so it's very easy to fall victim to all of these, kind of headlines is, "Oh, you're going to lose all your money if you don't do this." And they get sold into some very bad situation that's very hard to unravel.
Yeah, it's just one of the biggest acts of kindness and prudence that you could do, and it doesn't take that much effort. So we've been giving you guys homework the past couple of weeks. I would say, folks, your homework this week is to, at the very least, sit down with the loved ones that you want to make sure are cared for after you're gone, and just have the discussion of who do we want to have as the backup financial quarterback, right? Is it somebody in the family, or do we want to go find somebody, an expert outside the family? And that in itself is a great first discussion, right? And then if it turns out to be an expert outside the family, then you could have another conversation a little bit later, which is, okay, well, how do we want to go about trying to identify that person? So really, if you take nothing else from this whole conversation, it's to try to do that in the next couple of weeks, the next couple of days. And obviously, if you want to talk to one of the financial advisory firms that Thoughtful Money endorses, they are happy to have this conversation with you, even if it's just to help you think through the process. All right. Well, look, I've got a rant here, Lance. So let me go through it quickly. I think you and I have talked about this off air, but I don't think we've talked about it on air, which is sometimes you got to go backwards to move forwards. And I think I've been sharing. Pardon me?
Kind of like in the market.
A lot like in the market, yeah. But I've been pretty transparent with folks, and certainly on my social media channels, about the fact that I've been leaning pretty hard into a fitness regime, a strength training regime. And about a month and a half ago, I really just started realizing, you know what, these aches and pains I have are really becoming kind of debilitating. And I realized two things. I was definitely overtraining. So I was working out too intensely, too frequently given the intensity. And then secondly, I was starting to have some joint issues, and I was just telling myself, right, just train through them. And then I realized, wait a minute, you're actually doing more damage at this point in time, right? So part of this was just me telling myself, look, I got to give my body some, you're raising your hand. Yeah.
Yeah, I warned you.
Yeah. So giving my body some chance to heal, right? But also part of it too is I was, I've worked out a lot in my life in gyms. But it'd been a while since I had actually had a professional trainer actually look at my form and critique me and see where I might be doing wrong. And as I like to say often, by definition, we're blind to our blind spots, right? So I did go in and first have an initial consultation with a trainer, and sure enough, some of the big lifts I was doing, he said, "Oh, no, you're doing it wrong here, or you're making this mistake here," and really helped correct my form. And I've actually now been working with him a couple of days a week we brought the weights down a bit. We're now beginning to bring them back up, but making sure it's done with the correct form. And it's also helping with the rehab on my joints. And so anyways, I'm now getting, not quite back yet, but I'm now getting pretty close to where I was before, but I've got much better form and my body's in much better shape. And the two key lessons on this is, hey, sometimes you do have to step backwards. You've got to deconstruct what you're up to. take your foot off the gas a little bit, but make sure that the vehicle is going in the exact right direction and that you're driving it responsibly. And then once you do, then you can lean back in and you can start going a lot faster because you've course corrected, right? So I'm benefiting from that right now. It's also just a reminder to me too. I think I mentioned some of my mentors have been so successful because they have been pretty fearless about recruiting expert talent in their lives, whether it's a fitness coach, whether it's a financial coach, whether it's a relationship coach, whatever. Um, they try to find the best coach and then leverage the expertise of that coach. And every time I do it, I kind of resist it because I'm kind of a DIY guy and I feel like I've figured it out on my own and whatnot. But almost every time when I bring in a really good professional, I realize, oh, wait a minute, no. Like there's a reason they're an expert. They actually know more about this than I do. And it's such a force multiplier. It's not like a 10 or 20% improvement. In a lot of cases, it's like a 2 to 3x oftentimes. So the point there is hey, the places where you care most in life, if you're not making the exact progress you want to make, invest a little bit by bringing in an expert, even for starting with just a one-time consultation, and see what they may be able to identify, because they might be able to save you months or years worth of doing the wrong thing with just a little bit of expert insight. So I know that's the business you're in, Lance, but I'll let you respond to any or all of that.
No, I mean it's that's it's just kind of the function of anything is that we all get to doing things a certain way, whether it's running our business or whether it's managing a portfolio or working out or whatever it is, and we inadvertently develop bad habits along the way because of this is one of the most common. Well, this is the way we've always done it, right?
Right. Or you just drift. You forgot they said that was important, and it falls out of your brain. Yeah.
Exactly. And so this is the way we've always done it. That's kind of the big thing. And so, if you're running a business and your business isn't growing the way you want it to grow, we're all resistant about spending money on stuff, right? It's like, why am I going to pay a consultant to come in?
Right.
He charges so much money to come in. But yeah, you might spend $100,000 on a consultant to come in, but he may make you $5 million by changing something in your business, opening up a new product line, opening up something, new opportunity you weren't aware of. And that's really the thing we have to consider, that when we're managing our own money, can we do something to improve the process that we're doing? And again, we're always looking and searching and talking to other people and trying to learn and adapt and do different things. Some things work, some things don't. But that's the process you work through just building a better platform long term. Because you should always be trying to learn, always be trying to grow. And then whenever you reach these points of uncertainty, that's where you want to reach out, ask your mentors, hire somebody to come in, hire a coach, whatever it is. And it generally pays off in spades doing that. You may not like spending the money on it right now, but it will definitely pay off in the long term. And like in your case, you'll be able to walk when you're older versus that nonsense you were doing before. So
it wasn't nonsense, but I will. Let me just say one thing though, for folks, if you've got knee issues, go to YouTube, go to Knees Over Toes Guy. A great resource for rehabilitating your knees.
Yeah, I actually use that video to fix my knees. So absolutely.
All right. All right. Well, last thing as we wrap up here, I'll talk more about this in future videos, and I'll probably release a video in the next week or so, just specific to this. But YouTube has been, when you pass 100,000 subscribers, and you get the fancy plaque that we got for Thoughtful Money a couple of months ago. They give you a YouTube consultant, and they're looking at your business and they're telling you things they think you should do. And they have been trying to get me to turn on YouTube memberships for a good long while. YouTube memberships are basically, it's a paid perk for being a member of the YouTube channel. And so, they've been telling me why that's good for people and good for the audience and good for the channel and all that stuff. And I haven't done it to date because I'm busy with a lot of other things, but I don't like to ask people to spend money unless I feel like I can give them a really good value, like an overwhelming value in return. And there are all sorts of little perks that come along with membership. priority in getting responses to comments. There's some live chat. There's some dedicated content. There's some emojis and iconography and stuff like that. But I wanted it to be really material. So I spent some time talking with the expert and came up with the consultant, and actually finally the light bulb went off and came up with what I'm going to do. So on a twice monthly basis now going forward, I'm going to sit down and I'm going to talk on camera. And if I can do it live, I'll do it live. The number one question I get from people is, hey, Adam, you talk to so many experts every week. Like, what are the key takeaways that you personally are taking from these interviews? So I'm going to share exactly that. Like I said, twice a month, I'll sit down, I'll look at the interviews I've done over the past 2 weeks, and I will summarize what my key takeaways are, and if I'm taking any personal action in my life based off of that. So I'll be doing that. That's what members will get. If you're thinking about maybe becoming a member, you'll see there's a button, a join button right next to the subscribe button down right beneath this video here. It's $5 a month. It's not that much money at all. I think it's like 16 cents a day. So if that sounds interesting to you, then sign up for a membership and see what you like. See if you like it. This is something we'll try, and if folks like it, we'll keep doing it, and maybe we'll keep building on top of it. And if not, no harm, no foul. We tried something new. If you are already a premium member to my Substack, you don't have to sign up for a membership. I will make sure that you get that video as well. So I want to keep it really easy for people. If you want to like dip your toe in the water, sign up for a membership. If you want to get the full glory of all the premium perks that Thoughtful Money offers, then sign up for our premium Substack. That'll always be like the Cadillac version that just you get all the bennies. So anyways, more on that to come. All right, Lance. It's been a heck of a week for you, I know. I appreciate you taking so much time to make sense of it for folks, both today, but in the live stream yesterday. We got a lot of really good feedback from folks saying that they really like our ability to come in and do a live stream when there's something big going on in the markets like that. So anyways, I want to thank you for dedicating so much time to the Thoughtful Money audience during such a chaotic week.
Yeah, it's been fun.
All right.
I don't want to do it again next week.
Yeah, I don't know if it's been like fun for investors this week, but it definitely has given us some really interesting things to process and follow. Hopefully things will continue to be interesting, but hopefully in a more fun way for investors next week. But no matter what happens, you'll be here making sense for us next week.
There you go. Thank you.
All right. Any bits of parting words for advice on a week where maybe some people are looking at their screens and feeling like committing hara-kiri?
Just don't. I said this the other day, and is that the best thing you can do on a day like today or yesterday is just turn it all off and go focus on your job, or focus on your family, go play some golf.
Hug your spouse, hug your kids.
Yeah. Do something else, because there's nothing you can do about it today. There's no sense in sitting around staring at the screen, going, I wish I would have, or I should have, could have. That's not healthy and it's not helpful. So just, turn it all off for today. Again, we'll see what happens over the weekend. As we were talking, Trump announced that Vietnam has come to the table and they're negotiating a deal. So maybe we'll get some good news over the weekend. They'll get this market going.
They beat the Penguins?
Some rebounds. And maybe the Penguins may get a deal. We'll see what happens. So,
okay. Yeah. Jeez. All right. All right. Well, look, folks, if please show your appreciation to Lance by hitting that like button and then clicking the subscribe button below, as well as that little bell icon right next to it. Lance, brother, really appreciate it all. Look forward to seeing you next week.
You got it. See you then.
All right, everybody else, thanks so much for watching.